Welcome to session 24. Our topic will be zero delta rebalancing and higher moment trading. In the previous session, we talked about the opportunities that emerge in the option markets when it is possible to buy cheap volatility. In those circumstances, that is, when the implied volatility happens to be below the realized volatility during the life of the contract, it is possible to earn a profit. We also showed, however, that those portfolios in many occasions are still exposed to directional changes in the prices of the underlying assets. In these circumstances, it is possible to find a situation in which, despite the profits made by trading volatility, there are significant losses coming from the variations in the price of the underlying asset that more than compensate such profits. Here we're going to look at an alternative strategy. A strategy that considers building a portfolio of contracts and equities that in principle could be irresponsive to changes in the underlying price of the asset and that would isolate the directional movement of the equity from its volatility. In those circumstances, it is possible to profit out of volatility without the inconvenience of being exposed to the directional change in the stock. Let's see what we have in section 2.1 of our Maple document. What we see here is an interface. That interface shows a red line here, which is the payoff function of a portfolio. This portfolio will have long calls and short stocks. We will assume that these calls are at the money calls for a stock price of $100. The implied volatility will be 0.03, the risk-free rate 0.01, and the time to maturity for the calls 1 year. All these three sections are editable, so the user can change them in order to highlight some other features of this portfolio. Now, let's toggle a little bit with this slider. What we see, for instance, is that we could have portfolios in which the delta is negative along the way. That means that we can make money when the stock drops in price, but we will lose money when the stock increases its price. However, we can change the number of calls given the number of short stocks, and we could have a schedule that shows that it is possible to make money when the stock increases and also make money when the price of the stock drops. Now, ideally, we would like to have a portfolio that locally, around the strike price, which in our case will be the same as the price of the underlying stock, is zero. That is, when the delta is zero. Now, let's try to see if we can get a zero delta portfolio by looking at the number down here. In this particular case, we notice that with one long call and with about 0.6 short stocks, our delta is very close to zero. Now, let's see what we can do with this strategy. Let's assume again that the price of the stock is 100 and that it drops down to 90. At that point, this strategy will make about $4. That's pretty satisfactory, however. The problem is that if the price of the stock goes up again, then all these profits will vanish. So what we may want to do is that once we reach this point, we could reset our portfolio in such a way that we reestablish a relationship of zero delta. Let's think for a second that we reinvest the profits of this portfolio. That implies that we are able to buy more calls. Once we do that, our portfolio is unbalanced. So we need to change again the number of shorts in order to reestablish the proper balance. Here we have. Okay. Now, let's think that we can keep on doing that. We see that these lines get closer together, which means precisely the fact that having a larger portfolio with reinvestment, consecutive reinvestments, to the extent that we reestablish our zero delta, will guarantee that we will keep making money, and in each round, the amount of money made per unit of movement in the price of the stock will be higher. Now, let's go to section 2.2. In section 2.2, we're going to see what happens if we take this argument to the limits. That is, let's think of a strategy in which we continuously realize the earnings, the profits made by our strategy, and we continuously rebalance the portfolio. We will attempt to put together a sequence of Maple commands in order to see what would be the cumulative profits made by a strategy like this when it is A, sustained over an extended period of time, and B, when we follow very strict rebalancings in order to maintain a zero delta position. So let's go to step 0. We are already used to doing this, which means that every time we start building or putting together a set of commands, we begin with restart in order to clean the memory of our computer from any constants or variables that may have been still around. We're going to load 3 packages that we will use during this exercise: the finance package, the optimization package, and the linear algebra package. Now, let's proceed to define a function. This function will correspond to the value of a portfolio that will have a certain number of long calls and some short stocks. So let's look at how much our portfolio is worth. On the one end, we will have the number of calls, which multiplies the Black-Scholes price of those calls. So we are going to invoke the command Black-Scholes price from Maple for an underlying price of the stock S, for a strike price of K, time to maturity of T, implied volatility of sigma, a risk-free rate of R. We will put 0 here, which corresponds to the dividend yield, which for our purposes at this point are not is not relevant to have it. And we will let Maple know that we are working with call options. Here we are using the Black-Scholes environment, but we could use any other more complex if we want, in order to accommodate to the underlying stochastic processes for the stock. Now, in order to have this portfolio, we had to pay in C times the Black-Scholes price of a call, which was at the money, namely where the price of the stock is equal to the price of the strike. Then T, sigma, R, and other specifications are the same as in here. Finally, we have the short component of our stock position.